Most people assume that earning more money makes life simpler. More income, more security, more options. But the uncomfortable truth that I see every day, high income earners are often more financially vulnerable than they think. Not because they're irresponsible or not because they're bad with money, but because high income creates new risks that most people have never planned for. Hi, my name is Laurent Munier. I'm a partner. I'm an advisor at Say Pacific Financial, and we work with high-income Canadians and incorporated professionals, business owners across the country. One of the most surprising patterns that we see is that the higher someone's income becomes, the more fragile their financial plan is, unless it's like deliberately structured for risk. So today, I'm going to walk you through why high earners face different risks, the real numbers that expose those risks, and what actually protects high-income Canadians over the long term. So let's talk about the high-income illusion of financial safety. One of the most common and dangerous assumptions when you're a high-income earner in Canada is that earning more money automatically creates financial security. So in our work with successful professionals and executives and business owners, we hear these beliefs repeated over and over. Well, I can always make more money if I need, right? Or tell me if this sounds familiar, right? If something changes, I'll adjust. Or my income gives me flexibility and options. And in the early stages of success, that often feels true and often is true. But high income doesn't eliminate risks. It just reshapes risks into something else. So as your income rises, your financial plan often becomes more dependent, not less, right? High earners quietly build these structures that rely on everything continuing to go right. You've got dependence on continuing to earn this high income and not a lot of margin for interruption, continuing to be in good health, especially professionals whose income is tied to their ability to work, continued business performance, continued good contracts in your business or client flow, and stable tax rules, which can change. When even one of these variables breaks or changes, your illness or market disruption, regulatory change, economic slowdown, the entire structure is impacted immediately. And this is why many high-income earners feel financially stressed despite having high income and a potentially strong net worth, right? The plan works beautifully until it doesn't. So here's some real numbers and shows kind of why high income often means like high exposure. So this is a realistic Canadian example that illustrates this type of risk. So we're going to talk about a professional earning around $450,000 per year. So gross income. Gross income is $450,000. Personal taxes, $200,000, $210,000. Net take home, call it $240,000. This sounds like financial freedom to a lot of people. In reality, their typical annual fixed costs and semi-fixed costs are usually pretty high. Your mortgage and property tax might be $90,000 a year. Living expenses, utilities, food, cars, vacation, another $80,000 a year. You got kids, you got those child-related costs, maybe travel, insurance, other types of commitments, another $40,000 a year. So this leaves you roughly around $30,000 a year in true financial flexibility. So now is the question that most people avoid. What happens if your income drops by 30% for 12 to 18 months? This is not a theoretical scenario. This happens all the time. This could be a health event, business slowdown, you lost a big contract, something happened in your industry, the whole economy is down. So when this happens, your fixed costs probably remain fixed. Your taxes don't adjust immediately. It takes some time. Your lifestyle commitments don't disappear. So your cash flow tightens real quick. Suddenly, that margin, that 30 grand, gone. This is not financial freedom. This is called income fragility. So a high earner isn't vulnerable because they earn too little. They're vulnerable because their lifestyle, their tax exposure, their planning depends on continuing income. You can't interrupt earning the $450,000 a year. So without having a proper structure, without having discipline, without having liquidity, without planning for risk, this high income becomes what you call a single point of failure rather than a source of security. And this is the illusion that most high earners don't really realize that they're living in until it's tested. So why do high income earners break faster than middle income earners? So if you're a middle income household, you're probably already used to constraints that high income earners are not. So high income earners often build a lifestyle around their peak number, their peak income. They delay liquidity planning and they assume that the income is always going to be high. They rely on future earnings to fix today's problems. And when the income slows down, the expenses usually don't adjust fast enough, right? You don't stop paying $90,000 a year for your mortgage and your property taxes. That would take time to bring it down. You'd have to actually move. Your assets might be not liquid, right? Like a lot of your money might be tied up in your house. You've got big taxes and those are unavoidable. And your stress will compound very, very quickly. So, the fall isn't gradual, it's sudden. Like when one of these risks shows up, it really puts you into a situation. So here's one of the risks. You've got what's called tax concentration. So this is a very overlooked vulnerability for a high-income Canadian, is this tax concentration risk. So you don't just pay more tax, you've got a layered taxation that compounds when money needs to move. So here's an example just to clarify, right? So you've got money in the corporation and you need to take it out. This triggers corporate tax right away. Then when you need to pay it to yourself, it triggers personal tax. So that could be a dividend or salary. Or you take money out of your RRSP. So this withdrawal is taxed fully as income and probably at the top marginal rate, right? You're earning $450,000 a year, you're paying top marginal rates. If you get bonuses or lump sum income, this could even push your rates higher, right? And in some provinces, over 50%. Or an estate tax that arrives all at once. So if you don't have liquidity to fund these things efficiently, or you don't have advanced planning, tax becomes the single biggest destroyer of accumulated wealth. Here's some real numbers. Same type of success, different outcome. And this is a realistic corporate scenario. So this is somebody who owns a company in Canada, they're incorporated, and they have what's called a CCPC, a Canadian-controlled private corporation. And say they've been doing very well, and inside the corporation, you've got retained earnings, and they've accumulated around $4 million over the last how many years. Now, if you take the money out of the corporation without any sort of planning, and you took the whole thing out, probably like 2.1 to 2.4 million is going to end up in your hands after the CRA takes their chunk, right? You had 4 million, you took the whole thing out at once. You're probably going to pay almost $2 million in tax. I'm not saying this is going to happen, but this is for an illustration. If you took the money out of the corporation strategically, using tools like having a holding company, using your capital dividend account, using your GRIP account, using insurance-based strategies, you could probably put $3 to $3.5 million into your pocket after all the taxes are paid. So now, depending on how you do this, this could be a difference of $600,000 to $1.3 million. Same business, same $4 million that we started with, same earnings, same effort. The difference isn't success, it's the structure. And this is why high earners are way more vulnerable than they think. The higher the income, the larger the accumulation, and then the more damaging poor tax planning becomes, right? When you don't think about it in advance, that tax exposure, it concentrates instead of smoothing out, right? The bigger numbers means bigger taxes if you don't do it right. Now, here's another hidden risk, the liquidity risk, right? We've got other videos on liquidity on our YouTube channel. Click around, you'll find them, or make sure you subscribe. One of the most common and the most dangerous risks, and usually a blind spot that people don't really think about, is liquidity. From the outside, your high earning looks secure. You've got a strong net worth, you've got a valuable business, you've got maybe some real estate, your portfolio is doing great. So the wealth on paper does not automatically translate into usable money right now. So in reality, many people earn a high income, are asset rich, but cash poor or access poor. The money's tied up in places that are either difficult or slow or expensive to get the money out. So say you've got your money in your business. Well, you can't just easily sell equity to get cash without harming the operations or the valuation or taking a whole lot of time to find somebody who's going to buy this for you at the price that you want. People have real estate, very not liquid, especially in today's Canadian market when basically the real estate industry is just stopped. It's very market dependent and it's very expensive to transact real estate. There's tons of fees. There's tons of people you have to pay. There's lawyer fees, realtor fees, property transfer tax. There's potential other taxes that you haven't paid in the past. Like, it's very expensive to sell and to buy real estate. You have your long-term investment portfolio that's with somebody at an investment firm or maybe with us. So selling at the wrong time locks in losses, right? Markets go up and down. You're not always going to sell on the up, right? Unless you've really planned it out properly. And then you've got money inside your registered plans, like your RRSP. So any withdrawals from the RRSP is immediately taxable at your highest marginal rate. You do have a TFSA. You can take money out of there tax-free. Those are great, but TFSAs are very limited. You're not allowed to put a lot of money into them. So let's show some real numbers where the net worth doesn't equal flexibility. And I'm just going to show you this. This is a realistic example that happens like quite frequently. High income Canadian got a total net worth around $6 million. So on paper, looks great, financial security. But let's ask an important question. How much cash can you get right now without breaking this plan? What's the answer? So immediately accessible and practical cash, maybe this person can get 75,000 together or 100,000 together. That's it. Despite having a multi-million-dollar balance sheet, they might, struggle to handle a big sudden tax bill, fund a business opportunity, bridge some sort of income disruption, a health event, right? They might have to cover unexpected personal expenses, or maybe somebody else in your family had a health event, right? This isn't a problem of wealth creation. This is a problem of wealth usability, right? And it's why high income earners often feel stressed or constrained despite having significant success. That liquidity fragility doesn't show up in good times. It shows up when the timing works against you. And by then, when the timing is working against you, your options get quickly limited. Here's another risk. We call this time compression. So one of the most underestimated risks when you're a high-income Canadian is time compression. High-income earners are usually busy, they're usually successful, they're usually focused on growth. So as a result, the planning often gets deferred, right? Potentially for years. So this is the I'll deal with it later. I might even know this problem is here, but I will do that later, next year. Later never happens for some people, but later's also never neutral. So as the time passes, the planning options don't always stay the same. A lot of the options shrink and some of the options go away. So if you are a high-income professional or a business owner, delaying the planning can create big constraints, right? If it's insurance, it becomes significantly more expensive as you get older. The efficiency in your policies declines because you don't have as far of runway in front of you. So this could reduce your long-term average cash value growth. Or if you have tax decisions, those tax decisions can become locked in and you could have fewer opportunities on how to restructure and how to deal with those tax decisions. Your health risks increase as you get older. So this could limit or eliminate options altogether, especially if we're talking about insurance. So this time compression turns into what could have been a proactive decision into a reactive one. Reactive planning is usually more expensive and usually more limited in what you can do. So let's talk about some real numbers. These people have the same goal, different costs. And this is a simple and powerful example involving what we call a participating whole life insurance policy, which you'll see lots of on our channel. It's one of the most time-sensitive planning tools that's available, especially if you're a business owner or a high earner. And so for similar long-term estate objectives or liquidity objectives, let's say one person starting at age 35, they're going to put $20,000 a year into one of these policies. Let's say for the same thing, you're starting at age 50, this same policy is going to be $38,000 a year for similar outcome. Same goals, same coverage, almost double the annual cost. So now that difference isn't inflation. It's not a market condition. It's just lost time. Insurance is cheaper when you're 35 than when you're 50. So when you're compounding, when you're underwriting, when you've got this policy efficiency, when all of these things are delayed, that math changes permanently. The high earners who wait, they can often find themselves paying more for less or for less flexibility. And then they wish that they would have done it back then. Oh, I wish I would have done this sooner. Like we hear that all the time. The time compression doesn't announce itself. It just quietly happens. It quietly removes options. It quietly removes flexibility. So future you're not going to wish that you waited longer to set up your insurance. Most people that we talk to wish they had set it up earlier, or wish they'd set up their holding company, or wish they'd set up their trust, or wish that they got their taxes in order, or wish that they'd had planned out their capital dividend account, or wish they'd planned out their GRIP withdrawals. Like all of these things are easier when you have more time and more time ahead of you. Now, what actually protects a high earner over that long term? So when you are a high income Canadian, whether you're incorporated or not, real financial protection doesn't really come from doing more. It doesn't come from chasing a higher return or opening more accounts or adding unnecessary complexity or switching strategies. All of those approaches often increase your fragility, not decrease it. What actually protects is the right structure, that kind of structure that holds up when your income or your markets or your health doesn't cooperate, right? True protection, when you've got that type of high income or when you're a business owner, is built on a few foundational principles, and these are kind of universal. Number one is liquidity before you need it. You need to have access to cash that doesn't depend on time or forced sales. Another one is tax planning, and tax planning for the future, not just year by year, but like tax plan, like what's going to happen in 5 years if you keep doing this? What's going to happen in 10 years, right? You want to work with your accountant on that, and not all accountants are the same, right? We have a general rule of thumb to know if you're working with the right accountant or not. And our rule of thumb is, which direction are they looking? Are they looking in the past and saying, you did this, you owe this much taxes? Or are they looking in the future? Because you're doing this, and because you're set up in this way, this is what's going to happen next year and in 2 years and in 5 years and in 10 years. So generally, we will consult our clients to work with the future forward accountants, not the ones who just say, give me all your receipts, I'll do your taxes, call me next year. Those are providing a service, but when you're in the high income, when you're incorporated, you need the future facing accountants, and they're way more rare. And you need the future planning accountants that are going to give you advice, which are even more rare. Sorry, that was a little off rant on accountants, but definitely make sure you're working with a good accountant. If you need an introduction, we can do that for you. If you go on our website, send us a message. If you're a right fit, we can introduce you to somebody good. You also would want to have a coordinated structure. So your corporate, your personal, your insurance, your estate, your investments, your personal life, all of these things work together, right? And you want your financial plan to survive not having an income, because we don't know what's going to happen. So we don't just make your plan based on these peak earnings that you're earning now or that you're going to be earning soon. High income doesn't reduce the risk. What it does is it kind of concentrates that risk. What reduces the risk is the intentional planning that's done early, that's integrated, that's stress tested against the real world, not against a perfect Excel file. When your income slows down, when the markets crash, if life happens, if a health thing happens, this could even be just a divorce. This could be all sorts of different types of things. The difference between stability and stress isn't how much you earn, it's how much you kept, and it's how your plan is set up and how well it was built, and was it even done? Did you do it? Or is the plan something you're going to do next month or next quarter or next year or in 5 years? So how do we help? Where do we come in, right? All this doom and gloom. We don't just assume best case scenarios. When we're modeling portfolios or we're modeling insurance, we're going to show you like bad cases as well. We don't just build these plans that work when your income is strong or when markets are friendly. We help generally incorporated professionals, business owners, high-income professionals to design these strategies that work through change, right? The process is really simple. It's you stress test the financial plan against what if you're not earning income next year? What if the market crashes? What if real estate stops selling? We want to also build liquidity without having to sell assets. So if something comes along, maybe an opportunity, but also maybe a crisis, you can get cash to pay for those things that doesn't permanently damage your financial future. We also want to work on reducing your lifetime tax exposure, not just minimizing this year's bill. Obviously, minimize as many tax bills as you can, but you want to minimize your total tax bill. We also want to coordinate, right? Coordinate with your other advisors, coordinate your corporate, coordinate your insurance, coordinate your investments, coordinate your estate, right? All of these things don't work in isolation. You have this whole kind of ecosystem going around you. You need it all to work together and you need it all to go in the same direction. And then really, and this is maybe the most important, this plan needs to work when your income slows down or when your income stops, or if your business gets sold, or if there's some sort of big health event that like quickly will change your priorities, or if there's an estate event, right? That somebody passes away. How do we deal with that? How do we pay for these things? We want to plan for the downturns. We want to plan for the transitions. We want to plan for uncertainty. We want to plan for real life, not just a beautiful Excel spreadsheet that says you're going to go and be rich forever and the line goes up and to the right. And the difference between a good plan and just a plan is one that protects you over the long term, no matter what happens. This video is getting a little long, so I'm going to wrap it up here. A high income feels like security until it isn't. That great risk for high income earners isn't earning less money, but it's building a financial life that only works with the high income, assuming it's never going to slow down, assuming it's never going to stop, assuming it's never going to change. Now, if you are a high income Canadian or you own a business and you're really unsure on, how dependent is your lifestyle and your investments on these continued high earnings, or how much usable cash do you actually have right now? Or what happens if the market drops 20% tomorrow, right? Or what happens if it drops 40% tomorrow, right? This has happened a few times in the last 10 years. How exposed is your wealth? How exposed is it to future tax? How exposed is it to timing risk or to like a major forced decision that you weren't planning on? All of these things are going to probably happen. So now is the time to look under the hood where you have the options, where you have the time, where you can calmly have these conversations. Because when these things happen, all of a sudden your options get limited, it's stressful, and you maybe are not in the best position or best place to make these important decisions, right? So what can you do about it right now? Well, first thing is book a discovery consultation with us. It's complimentary. There's no pressure. There's no rush. There's going to be a link below this video where you can book straight into our calendar. And in this meeting, nobody's going to pitch you any sort of products. We're not going to guarantee that we can go and chase returns for you. We're going to walk you through real numbers. We want to identify where your risk is. We want to really understand your situation. And then we want to show you how to structure your corporation or your income or your liquidity or your tax efficiency so that your plan works, even if rest of life doesn't work exactly like it's supposed to. The goal isn't always to make more. It's to protect what you've already built and to make sure that future you has options. Now, if this video resonated with you in any way, please do the things that the algorithm loves. Click the like button, subscribe to our channel, share it with somebody who maybe is earning really well right now, but might be heavily reliant on that income more than they realize. The types of people that this video is for are very limited in Canada. It's only for a few % of Canadians that actually do this. So any help that you can get to spread this to more people that are like you, I'd greatly appreciate it. That's it for me today. Thanks for watching, and I will see you on the next one.